On January 31st, and I remember it well because it was the day that Microsoft, in fact, made its hostile overture to Yahoo, and I was asked to join a board meeting to consider the $49 billion bid. I was at an industry gathering and I listened to Stephen Roche, the perennially bearish economist, speak. And I can't tell you how often I've heard economists speak and it really hasn't stayed in the register. But in this case, Stephen had a lot of data which was incredibly compelling, and here's what he had to say, again in January. He said a recession of 3% was likely, and that was a time when the consensus was for slowed growth. He said that even though $100 billion had been written off, and that again sounded like a lot at the time, he thought that the write-offs were going to top $1.3 trillion. Now, he may be $1 trillion off to the light side, but he's still $1 trillion closer than anyone else was at the time. He said that Freddie and Fannie were already insolvent and that the government, the good news was, the government would be forced to bail them out. He said credit would tighten dramatically, gold would surge, volatility would reach all-time highs, and by all means, if you have the power to do so, short every financial stock. Let's just say he took the breath out of the room. No one could fathom, though, sitting there in January, that that could possibly be the truth, and we certainly didn't know what to do with the information if it was. So I guess, in one point I want to leave you with, if we look back at history, some people do have the ability to forecast if you look back far enough. So let's try an exercise. Let's try an exercise of not going to that yet. So sitting in January 2009, if we were to look back, what would we see? Well, the end of George Bush's second term, an African American making an historic run for president, a devastating market crash, a mortgage-related credit crisis, financial institutions failing before unseen scope and scale, and the government putting billions into them as a bailout, Middle East instability, and then a ensuing recession. So is that what we saw in 2008? Absolutely. But it's also exactly what we saw in 1988. The crash in 1987, George Bush finishing his second term as vice president, Jesse Jackson running for president, the S&L crisis. You see some themes repeated. Let's try again. Looking back again from our 2009 January perch, what do we see? Financial excess and over-leveraging. Deleveraging becomes job one, and credit seizes up. The largest bankruptcy ever filed. CEO compensation and short-term focus on earnings and driving up stock price are railed as the evils of the day. And after one of the greatest bull markets, the huge market correction. Scandals and fraud are discovered, recession again ensues, re-regulation takes full grip, and turmoil and U.S. interest in the Middle East create an overhang on the market. Again, is this what we saw in 2008? Absolutely. But it's also exactly what we saw in 2002. Following the internet bubble bursting, 9/11, WorldCom is the largest bankruptcy of the time, followed by Enron, the accounting scandals, and Sarbanes-Oxley. So if I could note, again, while we, and we hear this all the time, have never seen such a market, that's true, but does it mean that we couldn't have foreseen it? I think that's the real question as we go through the next cycle, and it's also as we hold our hands again at the bottom of this one, hopefully, and look forward.